Well, good morning, everybody, and welcome to our latest wealth webinar. My name is Craig Butler. I'm Head of Wealth Management here at Thomas Carroll. Absolutely delighted to invite you to welcome you onto our webinar this morning. Just having a look through our attendees, I can see many of you who have joined previous webinars of ours. So welcome back, and thank you for joining us again. And I can also see some new names on our attendee list as well. So thank you very much for taking the time to join our webinar this morning. I'm really grateful for you spending some time with us today. Today we're going to be talking about sustainable investing, a different subject matter for us today, and one that we think is particularly important. So many of us have changed the way that we do things in our daily lives to help us become more sustainable. Maybe we've stopped using single-use plastics. Maybe we've considered using renewable energies at home, or maybe more of a radical move and following a plant-based diet for the last couple of years and cutting out meat and dairy. So we know that there are tangible things that we can do in our day-to-day lives that help promote sustainability. But what about our investments and our pensions? What can we be doing with those to promote sustainability? And that's really what we're going to be talking about on the webinar today. So I'm absolutely thrilled to be inviting three of the sector's leading authorities on sustainable investing onto the call today. I'll give some introductions in a second, but let me just explain what we're going to do this morning. So we're going to start with some presentations from Jake, Emily and Mike, and they're going to be talking about different aspects of sustainable investing. And following that, we will have a question and answer session. So on your screens, you will see a question box. So please do pose any questions for our panel via the question box. And following our presentations, I'll field those questions to the panel. As always, our webinar today will be recorded. So if you do need to leave early for any reason, a copy of the webinar will be sent to you later. And if we do run out of time with questions, any questions that we're not able to answer, we will come back to you directly with a response. So let me start by introducing our panel today. Our first presentation is going to come from Jake Moeller from Square Mile Research. We were particularly keen for Square Mile to join our call, as they are an independent research company based in London. And Square Mile also manage our in-house portfolios for any of our existing clients that are aware. Jake joined Square Mile from Lipper, where he was head of UK and Ireland research, and he now supports research relating to ESG and responsible lending, and is a lead media spokesperson. So welcome to the call, Jake. Jake will then hand over to Mike Appleby from Liontrust. We really wanted Liontrust on the call today, as they are a specialist asset manager whose purpose is to positively impact investors, stakeholders and society. Liontrust were launched in 1995 and they have £32.5 billion of funds under management. Mike joined Liontrust in 2017 and he's responsible for the generation and integration of SRI research into their portfolios. And he's previously attained an MSc in Environmental Management at Imperial College London. And then finally, Mike will hand over to Emily Shaw from Cazenove Capital. Again, hello, Emily. We were very, very keen for Cazenove to join our webinar today, as they are one of the leading providers of wealth management services to the charity sector. Emily joined the business in 2011 and is sustainability lead and portfolio director within Cazenove. She specialises in sustainable investments and manages portfolios for charities, foundations and universities within Cazenove's dedicated team. So you don't want to hear from me today, you want to hear from our experts. So I'm going to come back to you in about 20 minutes time for our question and answer session, but let me hand over to Jake for our first presentation. Jake, thank you very much.
Thank you, pleasure to be here. We've got I don't have a lot of slides actually, so I can probably start without the slide being up. what I'm trying to do today is set the scene a little bit and hopefully clarify a few issues around where we have come from, the words that we use, and the way that we think about this. I go back a little bit, and I remember when I worked at an IFA called Towery Law, and back in that time, I think the figure of what we called ethical funds was about 3% of total investment association assets under management, and that was a high figure. You know, sometimes it was 2%. Went into ethical funds as it was then. And when you look at what's happening in the last 2 years, probably the last 5 years, but certainly COVID has really given us a boost in the way we think about this. The fund flows now are extraordinary. And not just fund flows, but product launches. We've got two very credible fund managers here today, but there are a range of funds coming to market. There are a range of funds being rebranded. There's a range of funds having their investment objectives changed to incorporate ESG or responsible investing. And it can be quite bewildering, the words, the concepts, and the way that we think about it. So what we've tried to do at Square Mile is make it easier for advisors to basically satisfy the advisor, the client need for ESG investing, but also make sure that the advisor isn't getting bogged down in the minutiae of trying to work all this out themselves. So we've developed a bit of a framework that helps the advisor put the client into the right portfolios or the right funds. Going to basics, we need to change a little bit about the way that we think about the types of words that we use, because the market has evolved. It's really matured. And this table here, the spectrum of capital, and by the way, Square Mile hasn't invented this, but what we've done is adapt it to incorporate our views and our terminology. What we've done is we've recognized that the market has evolved and that things have changed and it's become more sophisticated, and you know, this is a huge field. So what we need to do is work out what is the right solution for a client. This table is great because it really does outline the types of products that are out there now. And if we were to go back to my days at Towery, where the only thing you could invest in was an ethical fund, you know, then this evolved to become slightly less exclusionary. You know, remember, it was all discussions around sin stocks and tobacco and pornography and things that were generally bad. Things have evolved now. So what we have got is, if you look at the left-hand side, is traditional funds. Now, these are funds which I probably think in about 5 or 10 years won't exist as we know them, because every fund, I think, under the new world that we live in will have some degree of responsible investing in their mandate. These are funds that really don't have any level of consideration given to responsible investing. And I guess I should point out that from our perspective, ESG is an element of investing, not a means to an end. So ESG for us is about the way that a fund manager looks at a stock. It's not necessarily about whether the stock is avoiding harm or doing good or leading change. It's just a score, in the same way that a fund manager might use a discounted cash flow model. ESG for us is an input. And I think it's important to make sure that we don't think of things in terms of just ESG as the catch-all phrase, because I think that can actually misrepresent what a fund manager does. So we've got these traditional funds that don't do anything. They don't have an ESG screen, they don't have any responsible mandate, and they just manage money in stocks. The stocks can go anywhere, and the returns are basically free to represent the sectors that those funds are invested in. You won't see too many of traditional funds, what we call traditional funds, going forward. The next set of funds are the ethical exclusion funds, which a lot of us will be familiar. A lot of them are old religious funds. A lot of them are negative screens, so screening out stocks, sin stocks, tobacco, things that are bad for us. And that traditionally was a way that fund managers would avoid risk. And that was the way that the concepts were framed. ESG was about avoiding risk. That's the avoiding harm component. But where we've moved to now in this COVID world, Blue Planet, Volkswagen scandal, boohoo, we have moved into a world now where it's about doing good, not just avoiding harm. So we're looking for solutions. Now, there are two aspects to this. For us, a company can be responsible, right? A company that's responsible isn't necessarily investing in solutions that are going to save the planet. But a company that's responsible is doing the best operationally, the best job it can to minimize its behavior on society and the planet. So that could be a company that's trying to get its board diversity up. It could be a company that's trying to reduce its carbon footprint, things like that. But it's not necessarily investing in solutions. And that for us is a responsible practices fund. When we go along the right, we move into sustainable solutions, which I think is a little bit more of the deeper impact area. These are actually solutions to the planet's problems. And this is really, really important now because we are in a situation where we need to be investing and doing some things about some of the major problems that we face. Now let's talk about the environment. That's probably a pretty big one. So we've got to reduce carbon. We've got to invest in alternative energy. We've got to minimize exposure to black coal and heavy carbon industries. All these things are presenting not just about mitigating risk in the traditional sense, but providing solutions. And solutions, and the fund managers can probably elaborate on this, equals opportunity. So once upon a time, we used to think that ethical investing restricted your investment universe, and it did, because tobacco stocks would often perform very well, but you couldn't invest in them. So we used to think of these restrictions as suboptimal in some way. As you move down the spectrum of capital, and we move to responsible practices, sustainable solutions, we're not necessarily sacrificing returns, because what we're discovering now is that well-run companies will generate good returns. Well-run companies that are investing in solutions have the tailwind of consumer demand behind them. They have the tailwind of demographic change, and they have the tailwind of a lot of the new technologies that are coming to market that are actually going to help us reduce our carbon footprint, that are going to help us improve conditions for workers in Bangladesh and that sort of thing. So we also then move into impact investing, which is the higher end of this, the spectrum where you are genuinely putting first in your mandate that you want to save the planet. You know, that is your utility. And you're moving into a world where your primary objectives are not just financial outcomes anymore. And this is becoming increasingly popular, and we're seeing a lot more product come to market that offers funds in this space. And this is basically investing in funds that are specifically designed to have an impact and have a measurable impact in extracting carbon from the biosphere, or might invest in something that's specifically project related to affordable housing for people who can't afford it. So for us, this is a good way of thinking about this whole concept of responsible investing. Responsible practices, a company that's operating well, sustainable solutions, something that's actually going to provide a solution to a problem that the world is facing, or impact, taking the next step and making these solutions measurable and verifiable. And philanthropy, we don't touch on too much, but that's genuinely at the high end where you actually don't care about your financial returns at all. That's probably the world of Bill Gates. We can't all be in that world, alas, but that's the ultimate end of the spectrum of capital. So for us, that gives us a flavor of how we should be thinking about these funds. ESG is an input. These are things that companies and fund managers have been doing for years: governance, stewardship, voting. You know, this is just an input into the process, and we shouldn't over-rely on this. As we go forward, you're about to see two really good presentations, and they will be able to play a bit more color on how they think about it. But we're seeing new fund launches coming to market. There is less trade-off now for returns. You don't have to sacrifice returns to move down the spectrum of capital. There's a lot of evidence now showing that companies that are actually pursuing these objectives will outperform companies that don't. So we're moving into a world where that doesn't need to be a consideration. And from my personal perspective, it's a really interesting thing to talk to a client about. So if you engage your client in this conversation, it'll be mutually beneficial to you as an advisor, the client, and there's many ways you can, it's like the old active versus passive debate, but that's not interesting anymore. Responsible investing genuinely is. I'm very excited about it. I'm going to pass you over now to Mike Appleby, who's a sustainable investment manager at Liontrust, and that's a house that we know very well, and they do some great stuff on the responsible investing front. Mike, over to you.
Great, thank you very much indeed, Jake. So yeah, that was really eloquently put in what can be a very tricky area to look at. I want to focus today on, I suppose, if you like, the sustainable solutions that Jake was talking about before. And more specifically, I want to talk about sustainable investment trends. So this is about finding companies that are helping to deliver positive change and are basically providing us with the stuff that we need, and how doing that analysis can also actually end up with a really good opportunity set of companies that are exposed to structural growth areas across our economy that can help deliver really decent investment performance as well. So if we think about positive trends first, we'd be forgiven for thinking that there isn't really anything positive going on at the moment. It's all doom and gloom, and there are a lot of challenges that we have. But let's just wind back the clock a little bit and think about some areas where amazing progress has been made in our economy. And I'm going to start with the very tragic statistic of infant mortality. These are children that don't make it to their 5th birthday. And we have seen child mortality drop hugely. And if we go back about 100 years, it was as high as 20% of children wouldn't make it to their 5th birthday. And if we forward wind to today, this is down to a fraction of 1%. So huge improvements in reducing child mortality. Close to home, if we think about local air quality and particulate matter, PM2.5s, tiny little bits of dust that are very bad for our health, over the last 30 years, the incidence where in UK urban areas, this has been above the WHO limit for healthy environment to live in, has dropped by over 90% over the last 30 years. And similarly, if you look at road traffic accidents and fatalities as a result of accidents, over the last 30 years, again, this has dropped by over 70%. And that's despite 25% more miles being driven in that period. So what these 3 quick examples show is that there are positive trends that are going on in our economy. It's not to say that all those problems are totally fixed, and we need to continue pushing further with those. But a lot of these, behind them, there are innovative companies that have come up with solutions, be that vaccinations to reduce most of the causes of infant mortality from disease, be that companies that have innovated and made bits of kit that you can put on cars that massively reduces tailpipe emissions. And also in travel, we've seen, seat belts coming in. We've seen some really clever things start to appear in cars that make it actually very difficult to have an accident, active emergency braking and all these kinds of things. And I guess the philosophy behind all of this is you're looking at the world and thinking, right, what are the companies and what are the big trends that are going on or will be happening over the next 30 years? And let's try and identify the companies that are going to deliver those positive trends as they potentially make really interesting investments. If we could just go on to the next slide, please. So if we think about these sustainable trends, there are lots of them, and I would think of them in 3 buckets broadly. One of them is all about resource efficiency, and it's really to do with environmental technology, if you like. So The usual really important stuff like increasing the efficiency of how we use energy, how we use water, increasing recycling of goods, lowering the carbon intensity of the grid by putting more low carbon electricity generation onto it, etc. So I'd think of that as the resource efficiency bucket, if you like. The second bucket of these themes is all about our quality of life. So this is about improving our health, be that in how we manage disease and companies that are innovating in disease treatments to get better patient outcomes. Or that might be to do with improving our lifestyles and encouraging us to do more exercise or be able to eat more healthy food, which stops us getting a lot of the non-communicable diseases in the first place. This also includes things like education. And then the final bucket, which is a bit more esoteric, but this is to do with resilience. This is we all rely on systems and we want those systems to be more resilient. So for example, the ability to insure ourselves against risk is a positive thing. The classic example here would be cybersecurity. As more and more of our lives go online, it's critical that that information is kept safe. And if you talk to chief technology officers, the one area that they're really not cutting back on spending is to do with cybersecurity, because as one of them pointed out, you only know if you spent enough when it's too late. So there are a couple of points I want to make about these trends. First of all, there are lots of them, and they go right the way across our economy. And by understanding and finding companies that are helping deliver these positive trends, they typically are going to experience long-term structural demand for their products over and above that which you're going to experience in the market as a whole. So this can help you find lots of different areas of structural growth right the way across the economy and help you build really diversified portfolios that are exposed to all those trends. And this helps with your investment performance. It helps you deliver very competitive investment returns. If we could just go on to the next slide. I just want to finish by making the point that this is about sustainable investing. And sometimes people forget that this is there's a little bit more going on here than simply finding lovely companies that are doing really nice things, buying them and hoping that they're going to outperform and the good guys are going to win. And what's critical is that all this talk about sustainable trends, positive management, etc., it has to get included in the investment process. And if we can just go on to the next slide, which I'll finish up on. So we believe that for any investment, whether it's in a sustainable fund or not, for it to stand a chance of outperforming, there are 4 broad aspects that need to be right. And one of them is they need to be the right side of the trend. I've talked about this this morning, and it's critical that you're not, fighting against those trends, because that makes you a much less interesting investment. The second aspect that needs to be right is you need to look at the whole company in terms of the products and services they're providing. It's great if a company's got 10% that's to do with energy efficiency, but what's the other 90% doing? What's the business doing overall? And also, how well is that company managed? How good is it at identifying the key things that it needs to manage well? And we think that's a really good proxy for the quality of management. Generally, good management teams that are going to deliver on their strategy are really positive and good at this. There are still reactive companies that are really not very good at this at all, and that's a good indicator of the quality of the management team. So those are the 2 sustainability inputs. On their own, unlikely to outperform, although it would be great if they did. Some other fairly more normal things that you would expect fund managers to talk about. I've called this business fundamentals. This is just, is the company going to be profitable? Is it doing something that's hard to copy? Are they likely to continue to generate decent investment returns And then the final bit is the company undervalued? We look at these generally on a 5-year holding period or longer. What assumptions are we having to make to believe that this company will be worth a lot more in the future? And it's when all 4 of these aspects are positively aligned, that's what we would define as a sustainable investment. And you should have lots of these sustainable investments in a diversified portfolio. That's what it's all about. I'm going to stop there and I'm going to hand over now to Emily Shaw from Cazenove.
Thank you very much, Mike. Now I'm going to take the concept that Jake and Mike have outlined, which is investing along the spectrum of sustainability and identifying different environmental and social trends, and how you would look to combine that into a total portfolio approach so that you can maximize the positive impact of your total wealth. If we move on to the next slide. We also in Cazenove categorise our sustainable investments under the impact management projects framework of avoiding harm, benefiting society and contributing towards solutions. It's a fantastic framework that's applicable across different asset classes. So it's perfect for us when we're managing these multi-asset, often multi-manager strategies, as it enables us to truly understand how much of our portfolio is in those higher impact investments. Now, if we think about that spectrum, when we're constructing a sustainable portfolio, obviously it's a priority that we are avoiding harm. We can't be using our capital to invest for a better future whilst allocating to companies that are putting that future at risk. So that forms the foundation of that approach. And as Jake outlined, that will combine negative exclusions and ESG integration. We then want the majority of our mandate to be invested in those sustainable leaders, as identified by Mike, that are really helping to drive social and economic development through their responsible business activities. And then we want a core portion of our mandate that's actively looking to tackle environmental and social challenges by allocating to those environmental and social themes and higher impact investments. And as you can see by the schematic on the right, we group our environmental and social themes to be aligned to core sustainable development goals, outlined as 5 key buckets. And it's this element that I really want to be focusing on today, because I think it gives you the evidence of how you can use your capital within your investments to really create positive change. If we move on to the next slide, Mike quite perfectly outlined how you can invest in this way within equity. So I thought I would talk a bit more about different asset classes, for instance, fixed income and bonds. So here's a great example of a strategy that we're investing in that we think materially contributes towards tackling climate change, which is the Lombardo Climate Bond Fund. Now, this manager looks to invest in green and sustainable debt that is looking to tackle climate change and help mitigate and adapt to those issues. Now, green bonds are very similar to traditional debt issued by corporates, sovereigns or governments, but the proceeds of the debt are ring-fenced to go towards some kind of project that's going to create positive environmental outcomes. We've got a fantastic example here of a debt issuance that they supported, which was issued by the Asian Development Bank. This particular project was looking to finance, this particular bond was looking to finance a project that was going to help supply renewable and clean energy to off-grid areas where members of society currently had no access to electricity. Now, rather than setting up a dirty fossil fuel power plant to provide them with energy, this project was going to give them clean energy, particularly focusing on providing facilitations for education and healthcare facilities and improving the lives of women and girls in those areas. The particular project over a 5 to 10 year period was going to install enough renewable energy capacity that the greenhouse gas emissions saved will be the equivalent of the energy required to power over 8,000 homes. And as you can see, they equipped 6,900 girls' schools with solar panels and 500 healthcare facilities, as well as specifically training 3,000 women on how to use these electrical devices. So clearly some quite material benefits for both people and the planet coming from this bond issuance. If we move on to next slide, here we have an example of an alternative investment, which is the Schroder's Big Society Capital Impact Trust. Now, Big Society Capital are specialists in high impact investment that's looking to tackle the root cause of social issues in the UK. The Impact Trust that they launched in collaboration with Schroder's holds a range of the different projects and investments that they are supporting. For instance, high impact social housing, which is providing housing for survivors of domestic abuse, giving debt to social enterprises, such as those supporting people with learning difficulties, or facilitating social outcome contracts. For instance, a particular project where they were looking to keep children who are on the edge of going into care with their family groups. Now, clearly, tackling these issues has meaningful benefits for these very vulnerable people within the UK. But what's also fantastic for investors is that the underlying revenues tend to be backed by the government, which means they offer a high level of stability of returns and a very low correlation to traditional equity and bond markets, which means it's a great diversifier within a multi-asset strategy. Not only is it creating material benefit for these very vulnerable groups within the UK, there's also economic benefit for the UK, because by tackling the root cause of these issues, it saves the government and the taxpayer a huge amount of money in the long run. So quite material, social and economic benefits. Now, if we move forward, we think it's very important that we can evidence the positive impact that's coming from a total portfolio approach. You can see a few of the key stats that we've surfaced from our recent impact report on this slide here. We have classified all of our holdings throughout all of our different fund managers along the ABC spectrum. So we can quite clearly see that 77% of the mandate is directly benefiting society and 31% is actively contributing towards solutions. We can also see that in terms of our planetary impact, we've materially reduced our carbon footprint compared to that of a global equity mandate. And we use Schroder's award-winning impact measurement tool, SustainX, which looks at all company activities from the level of tax they pay, their diversity employment practices, as well as their products and services and the impacts that they create, and looks to make a net assessment of whether that business is creating a positive or negative impact on society. By creating a quantifiable metrics, we can truly understand and demonstrate the positive impact that this selection approach has created. And as you can see on the middle of the slide, the positive outcome is meaningfully increased compared to that of a mainstream global equity index. Now, if we move forward and look at those higher impact investments, so that 31% that's directly contributing towards solutions, we've grouped these in line with key sustainable development goals and grouped those goals under 5 key themes. So you can see how much of your capital is going to tackle these different areas. Clearly, climate change is a core theme for us. That's for 2 key reasons. It is the biggest challenge our society faces, and if we do not get to grips with it, it will have catastrophic impacts. But it's also a fantastic investment opportunity. The amount of seismic change that needs to occur in order to create the energy transition is creating a huge amount of disruption and investment opportunity. And that particular theme has been incredibly profitable for our mandates. And on to profitability, looking at the portfolio returns. So in our survey that we did earlier this year, it identified that the key barrier for people moving to a sustainable investment approach remains concerns about having to give up financial performance. Hopefully this slide evidences to you that a sustainable mandate can deliver very strong and attractive financial returns both compared to the peer group represented by ARC Steady Growth and an inflation plus composite. In terms of our expectations for returns going forward, we by no means think you need to give up financial performance, and actually we think that it should at least deliver the same return as a traditional approach, if not better. Thank you very much, and now I'm going to hand back over to Craig and answer some of your questions.
Super, thank you, Emily, and thank you also to Mike and Jake for your contributions. Well, I'm really pleased to say we've had some great questions already. Please do continue to send your questions in on the question box, and we'll certainly get through as many of these questions in the next 22 minutes as we can. So the first question, I think, Jake, this one is probably directed at you initially, but Emily, Mike, please do jump in with any comments you've got. So the question we've had is, if I'm investing sustainably, does that mean I'm taking more risk as there's potentially less investment choice?
Good question. The short answer is no. The risks do turn up at the far end of that spectrum that I was talking about. So if you start investing in the impact space, you need a longer time horizon for some of those projects to be paid off or to see the full fruition. They tend to be slightly, depending on the investment type, slightly less liquid. But there's no reason, if you're sitting in the middle of the sustainability or responsible space, that you should consider those investments more risky at that point. None at all.
Super. I think off the back of that question, we've had a second question come in, specifically around impact investing. And the question is there evidence to suggest that impact investing does mean that an investor is going to be taking higher risk, or potentially that returns could be lower? So I think this is sort of going back to the spectrum of capital and suggesting that, maybe impact investing does mean taking more risk. So is there evidence that supports that theory?
I'm happy to answer that one. I think actually, as with all investment opportunities, it will very much depend on your asset class and the type of investment that you're owning. There will be those high impact investments that can be less liquid, and as Jake said, we'll need a longer lockup period in order to deliver the returns, but actually they can be quite profitable and rewarding financially as private assets can often be. So you could potentially be looking at higher returns if you're prepared to take that longer lockup period. And then you will also get things such as social and environmental bonds, where actually the evidence more recently has been that the returns on these compared to traditional fixed income have been a little bit lower, just because the demand has been so strong from investors, which is ultimately pushing up the premiums that you're paying for these issuances. However, on the flip side, they've also been more stable and less volatile than traditional debt. So actually you're gaining a reduction in volatility for your mandate whilst having to give up, a marginal amount of long-term financial returns. The way we like to think about it is in your total portfolio approach. So thinking about all of your different asset classes and all of your different impacts that you're creating, combining them together so that ultimately you're achieving the overall financial objectives, despite the fact that different instruments within the portfolio will be contributing different types of returns.
Super, thank you, Emily. Okay, next question. I'm going to direct this one to Mike initially, if I can, Mike.
Yep.
So, question is this just a trend? And am I going to need to consider changing my investment strategy in the next couple of years? I suspect this is maybe I've invested in an ethical fund previously, and now I need to do something different because I'm being told I should invest in an ESG fund. What are your thoughts?
Well, it's interesting because when we started doing this, our funds just had their 20th birthday. A lot of people thought we were bonkers, and didn't really get this whole idea that you can generate competitive investment returns by investing in companies that are delivering positive outcomes. I think if we step back, I'm going to flip it around the other way. I think there are a lot of challenges. There are a lot of things that are going to affect our economy. For example, with climate change, a lot of people think that it's all about renewable energy, and obviously renewable energy is critical. But if we woke up tomorrow morning and all of the electricity generation on the planet had been replaced by some magic elves with renewables, we only would have reduced our emissions by about a quarter. So there will be tightening global regulation right the way across the world, right the way across our economy, including how we heat and cool homes, including how industries work, including transport, including food and agriculture and land use. And so I think that it's a very sensible approach to ensure that the fund manager and the team that are making investment decisions that are going to be happening over the next decade and beyond, they really need to understand this, and they really need to be positioning their portfolio. I think the days when many mainstream fund managers thought a lot of the classic reason why they didn't do this was that it's not material within our time frame. I think that is a very dangerous place to be. And so to answer that question, I think that some form of sustainable investment in at least some of the investment portfolio is going to be relevant, and what's relevant to you is something that you would need to discuss with your advisor, given what your views are and how you want to invest, but also what your risk appetite is. So yeah, I don't think this is a flash in the pan thing. I think it's just common sense investing, and I don't think it makes any sense not to understand these big trends and the ESG drivers that are affecting businesses. I think it's the optimal way to invest. So it's not something that's going to be all changed next year. I don't think that'll be the case.
Super. Thank you, Mike. Right, really interesting question here. I suspect we're going to go to Emily for this one. So, Emily, give you some forewarning. The question is, how or can I follow a zero carbon strategy? Is that achievable right now?
Well, unfortunately, it's very, very difficult to avoid all carbon in your investment strategy. You'd have an incredibly concentrated universe because, unfortunately, the market is just nowhere near our net zero ambitions. We know that that needs to accelerate and change, which is why you want to be investing in those companies that are making strides towards this. But it's very difficult to have zero carbon. The approach that we've taken in our sustainable strategies is, as you see, it's a very low carbon strategy. We've reduced our carbon footprint by 68% compared to that of the global equity market. But for that remaining 32% that we can't currently avoid, we are funding environmental projects across the world that are certified as carbon negative, and therefore we are effectively offsetting our remaining carbon emissions. And these types of projects are mangroves restoration in Madagascar, or biodiversity restoration in Uruguay, as well as planting lots and lots of trees. So very, very important projects that are reducing the amount of carbon in the atmosphere and creating carbon offset, which effectively means that our equities are managed against, zero carbon. However, I will just say on the flip side, carbon offsets are not the long-term solution. We need to get to net zero, and we have committed to achieving that within our strategies. But whilst we get along the way there, using carbon offsets to offset the remaining footprint is a great way to boost our positive impact.
If I could just chime in for a moment. Yeah, so it's certainly possible to get competitive investment returns by investing in funds that have much lower carbon intensity. The companies in that fund emit way less than the market as a whole. Across our range, it's about 75% less. Some funds are higher, some funds are lower. And so that's important, but also we have something called a 1.5 degree challenge, and we're speaking to all the companies we're invested in and saying, look, you know, we want you to go back and come up with more ambitious decarbonisation targets, because the science is saying that essentially we need to halve our emissions every decade. And there are some companies that are all over this and are doing that and beyond, but there's still a lot of the economy which just aren't, and some of the economy that still haven't really worked out that this applies to them. And so through that engagement, you can encourage companies to be much more proactive, because ultimately it's very naive of an industry, any industry, to think that it's going to be exempt from global tightening greenhouse gas regulation. And ultimately, it's going to give the company a competitive advantage to be able to deliver lower carbon products and services in a world that wants them. So it is possible to have much lower carbon intensity out there, and to have fund managers that are really being quite aggressive with their demands of companies, because they think ultimately not only is it a cool thing to do and an important thing to do, but it's also makes a lot of business sense too.
Super, thank you both. Great answers from both of you there, thank you. Mike, another question for you. Sorry, you're in demand today. So there's a question around how you specifically work with the companies that you invest in. So, you know, what is your relationship? And I guess, you know, at a sort of high level, what does your due diligence process look like that, you know, helps you decide if someone is going to sit in one of your funds? Emily,
yeah, so yeah, so I mean, we do a lot of work to ensure that companies aren't doing the things that we have specifically avoided, and we get a third party to help with that. And essentially what we're doing is our sustainability criteria screens out roughly about half of the market. So we're concentrating in that half of the market which is populated by companies with better products and services in terms of sustainability as compared to the market, and that are more proactively managed. Once we're invested in a company, we are still quite aggressive in terms of what we want. So to give you an example, in our voting, which is a way of measuring how demanding you're being on a company in equities, certainly, you know, about 2/3 of the time, or 2/3 of the companies we own, we voted against or abstained on something, which means that we are trying to drive change and get things happening. So we're not just sitting there and voting in favor with management on everything and telling them what an amazing job they're doing. We're saying, look, we really like you, you're in your industry, you're a company that we particularly like, but we still think that there are areas you can improve, and are quite demanding of companies. And ultimately, if we feel that we've misevaluated a company and that they're not being really proactive, and not sufficiently responding to what we do, asking them to do, ultimately that would eventually lead to us downgrading the stock and selling it eventually. But if you do enough work to begin with, generally speaking, that's something that happens fairly rarely. So yeah, we do a lot of work to try and find those good companies to invest in. We're not, our approach isn't trying to find companies that aren't very good at this and encouraging them to be much better and hoping that they'll be worth a lot more because of their ESG credentials later. We want to have companies that we already believe are on top of managing the key material risks to their business, because we think they are material. If you get health and safety wrong, or you get product safety wrong, or you have a problem with your staff or something, it can be very material. So that's our relationship. So we try and get the better companies, but we're still very demanding of them when we're investors.
Super. Emily, anything from a Casino perspective that you would want to add to that question?
Yeah, very similar. So both when we're selecting direct investments, so companies to invest in, and fund managers, you have to do a huge amount of due diligence before purchase as well as throughout to ensure that they meet your standards on sustainability. Absolutely no company or no fund will be completely perfect. So you need to keep up that due diligence and that dialogue so that you can continually improve their practices and make sure that they're meeting the bar that you have set before that initial purchase. What's really helped our process with our fund selection is that we have asked all of the fund managers that we're investing through in our sustainable models to commit to reporting against the ABC framework and to provide us with that underlying breakdown of all of their positions, so that we now can see exactly all of their underlying holdings and how they've classified them along that sustainability spectrum. There is still a lot of evidence of overstating. So even some of our favoured managers that we think are very authentic were classifying some of their positions in that higher impact space, which we didn't quite agree with. So had we published our impact report with that breakdown based purely on what the asset managers said, it would have had a lot higher allocation to those impact investments. But actually we knocked a few down back to where we think that they're just doing responsible practices within what you would expect to see of a company, rather than directly contributing towards change. So there is still challenges in the market, and it's part of the reason why you need to have specialists who've got the resource to enable the level of due diligence that is required.
Super, thank you, Emily. Okay, Jake, I'm going to come to you for this next question with your independent researcher hat on. Client of ours has both sustainable funds and traditional funds, and their sustainable funds during the pandemic seem to have performed a lot better than the traditional funds. Now, obviously, we can't comment on things like risk profile, etc. But the question is, generally, my sustainable things seem to have performed better during the pandemic than my traditional. Why would that be the case, or is that the case?
I was looking at a study yesterday in the US. They looked at 25 of the biggest sustainable tracker funds and ETFs in the 1 year from 5th of March to last year to 5th of March this year, which is 1 year into the pandemic. And 19 of those 25 funds had outperformed the S&P 500, which is probably the hardest index to outperform. So yes, there is anecdotal evidence that is the case, but there are many reasons. And as an analyst, it's not always the responsible factors that get me. I mean, a company that has low leverage, doesn't have a lot of debt on its balance sheet, will outperform relatively during a drawdown. A company that's got good quality factors will generally be more resilient during a drawdown. A company that's got a diverse board will generally have better decision making at the top level and will make better decisions during periods of volatility and difficulty. But not all of these are specifically responsible factors. But I think we can now conclude that those responsible factors are leading investors, like the two we have here, to invest in businesses that are, by virtue of those characteristics, the responsible characteristics, are investing in good quality businesses, which by virtue of their responsible ethos are generating good shareholder returns, avoiding harm, and getting good access to the capital markets. A bond investor who is a responsible lender can generally access lower costs of capital. So these are the factors that are going to be making those sorts of performance characteristics a lot more durable. So I think, yes, a good question. I think the short answer is yes, but it's not always a responsible factor. But I think there's a higher correlation now to those factors and responsible criteria, which will make returns, a lot more resilient in a drawdown and drive returns for growth with tailwinds behind them.
Thank you, Jake. Mike, please.
If I could just add, I'm just able really to talk about our funds, but I guess the first thing to say is that these funds had delivered very competitive investment performance versus their conventional peers prior to COVID happening. COVID was something that none of us really predicted, and has been pretty extraordinary. And I think the two main drivers that in 2020, if you like, that drove performance in our funds was, one, we didn't own a lot of the things that led the market down. So we didn't own big oil, we didn't own, had a very limited exposure to materials. All these things are generally driven by commodities. Commodities crashed because of the demand falling off a cliff. So that was one area that that helped the relative performance. But the other area was also a lot of companies that we own did phenomenally well in the lockdown. And if we think about that, so companies like DocuSign, this is a company where you can sign things online. You don't have to print it out and send it around. You know, the demand for their product is massively accelerated. And so it wasn't just avoiding, you know, the old economy that helped us. But I think the big question is, you know, going forward, if you think over the next decade or so, a lot of these, so COVID had a different effect on different of those sustainable trends, if you like. Some of them were massively accelerated. Anything to do with working from home, anything to do with connecting people, cybersecurity, digitization of things that people were using, you know, was experienced super normal growth. Some things chugged along same as, you know, a lot of the climate change stuff that we were invested in, amazingly, they were still, you know, installing solar panels in the US through the COVID thing, etc. They were incredibly resilient. And there were some other things that were put on pause. So the classic example would be public transport, modal shift away from cars onto public transport. No one wanted to go on public transport. The other one was to do with affordable healthcare, essentially going to gyms. You know, they were shut. So I think it's part of this diverse range of themes. You know, some of the things accelerated, some of them carried on, and some of them stopped. And what we're seeing is, in some ways, not a reversal, but a return to more normal, where a lot of those trends that happened during the lockdown are flipping over. And the only thing I would say that, while we have multi-asset funds and run a corporate bond fund that sits in there as well, certainly in terms of equities, because we're looking at high quality companies that are generating good investment returns, that are really well managed, that are exposed to these positive trends, they're generally quality growth funds. You can think of it like that in terms of, you know, how you would classify them differently. And so, as with any quality growth fund, they will generally do the opposite of what deep value is doing. And so that's maybe a way of looking at it.
Can I just add on to that? Because I think it's been really interesting those last couple of quarters, because having performed so well over the last 5 years, and particularly over the period of COVID, everyone's now been concerned that sustainable mandates will deliver a period of underperformance, because we see this rotation in the market back towards, you know, we've seen the oil price rally, we've seen miners rally, etc. However, what we've seen so far is that our sustainable mandates have continued to deliver positive returns and outperform the market. So despite the fact that we don't have high levels of exposure to these more cyclical and value areas, you're not guaranteeing that you're not going to perform. We're still delivering positive returns, which I think is testament to the fact that these themes are so strong and so seismic that they will continue and they will be multi-decade investment opportunities.
Super. Thank you. Thank you all for your contribution to that answer, to that question. I am incredibly disappointed to see that we are 1 minute past 11, and I appreciate that we all have very busy days ahead of us. We have quite a few questions that we've not been able to get through. Those questions, we have a record of them, and I will certainly share those with Emily, Mike, and Jake, and we'll come back to you individually with answers. A couple of very final points for me. Firstly, I'd like to say a huge thank you to Jake, to Mike and Emily. Based on the questions, we've certainly arranged a fantastic panel for you this morning. So thank you to the three of you. I really do appreciate your time, and I can see that our attendees do as well. There will be a short survey that will come out. We're always keen to learn from our webinars, so please do take the time just to answer the survey. A copy of the recording will be sent to you as well, and we do have some support material that we can send around slides and some other bits and pieces as well. So if there's any further information you would like, please do get in touch with us. So thank you all very much for attending, and I wish you all a very happy and safe day. Thank you all. Take care. Bye.